Hey everybody, it's Hammer. I am here to share with you guys what's going on with rates this week and over the next couple of weeks. Flying solo today, so both Nathan and Christopher are a little bit preoccupied this week. So thanks for joining me. Remember, you can join us almost every week. We try to do this consistently every Wednesday at about this time. It's 12 p.m. Eastern, and you can do the math based on where you're at. And if you have any questions, you're welcome to share them in the chat. I'm going to go ahead and keep an eye on those comments today. And if you're watching on the replay, do me a favor, give us a hashtag replay. Let us know that you did watch this and that it does help you. And if you would like to, get some more information on anything that I talk about today, let me know. So if you got any questions or if you want to know about, kind of more for your unique scenario, if you've got some questions on that, let us know. We'll be glad to answer them. And all right, everybody. So I'm going to try to pull up my screen here as well. And forgive me, I'm not quite as familiar with driving on this end, but here we go. All right. So today we've got our mortgage rate conversation. It is July 13th. And 2022. And today, let's start off by going over kind of what the expectation was at the beginning of the week. So I write a weekly rate forecast every Monday. And the idea there is trying to figure out what do I think is going to happen that week. We do a quick recap what happened last week and what what I forecast is going to happen the next week and why. So let's talk about that. So the first recap of the previous week, the week for the 4th, actually, mortgage rates were just a little bit higher last week, and it wasn't totally unexpected. We had seen rates improve after, hitting their worst level since 2008. That was right around June 10th, 11th, 12th, and that was after we got some inflation data. Back then, we got a report called the CPI, the Consumer Price Index, and that data sparked a sell-off. And when I say sell-off, I'll explain that for you. Basically, it sparked higher mortgage rates, right? And we saw rates push up to levels that we hadn't seen since 2008. Now, thankfully, a couple of weeks later, they improved again. They started to get better and better as markets and investors calmed down over this risk of inflation. Now, the inflation data, we're going to talk about that because we got that same report, which last month pushed rates up into, for some up as high as into the 6s. We got that report again today. So we got this month's version today. I'm going to talk about that one. But as we go ahead and take a look here and show you kind of what else we got going on here, rates were still significantly better last week, even after moving up a little bit than what we saw early in June when everybody was panicking that rates were going to go up higher. So the forecast on Monday, what were we going to see this week? What was I worried about? And what am I, kind of thinking rates are going to go over the next few weeks? And let's talk about that. So the forecast on Monday, I said this week's mortgage rates will be most likely to move on Wednesday. That happens to be today, of course, after the release of consumer inflation data. And that is a particular report. Like I said, it's called the Consumer Price Index. So last month, this inflation data caused rates to skyrocket higher as inflation readings came in stronger than expected and markets panicked. It's possible we could see another strong reaction this month, depending on the data, but it's less risky that we will see rates jump this time because markets are already expecting larger Fed rate hikes at this meeting. Okay, so that's kind of where we're at. So for those of you that maybe you ever see that term TLDR, too long didn't read, let me give you the too long didn't read version of what we've got going on. So mortgage rates are better than where they were a month ago, but not quite as good as where they were about 6 weeks ago. All right. However, still really, really good rates. Where do we think rates are going to go over the course of this week, next week, and the next couple of months? Well, over the near term, right? If you've got a loan, if you've got you're in contract, you're going to be buying a property or you're in the middle of a refinance, you need to look at how much time do you have before you need to lock in an interest rate, because that's where we look at, hey, how much can we forecast and where are things going to go? So if you need to lock in an interest rate over the next couple of weeks, maybe you're very close to your closing date, then where do you stand? Well, you didn't want to lock in this morning because mortgage rates this morning were a little bit off, and that was due to that inflationary data. Okay. However, it's a good time to lock probably if your lender has gotten better pricing, because mortgages, they actually can change rates in the middle of the day. It's not just once a day. So I don't know if you ever noticed at a gas station, there is a federal law that gas stations can only set their gas prices once a day. So that price on the pump goes up in the morning. They're stuck to that price for the day. However, mortgage rates, not the same. Mortgage rates change based on what's going on in the markets. So this morning we saw rates get a little bit worse than where they were yesterday. Not anything to panic about, but just not quite as good. However, we've seen improvement through the day, and that's put us in a position where a lot of lenders starting to issue reprices better. So they're saying, okay, mortgage rates this morning, maybe you were at 5.25 or 5.5, depending on your loan scenario, and let's say 5.25, right? And then now you can maybe get 5.125, 5.125. Maybe you're going to see better rates, or maybe you'll get that 5.25, but you'll get a little bit more rebate. You'll get a little bit more credit towards your closing costs for taking that rate. Or if you were buying into a lower rate, maybe it's going to cost you a little bit less. So that's what we're looking at this morning, is that today things are improving. And the reason, let me go a little bit deeper. Let me share the screen with you. I want to show you. And again, if you guys have any questions, even if it's on the replay, put them in the comments, let us know, and I'll answer them for you. We do monitor this thread through the week. So I'm going to go ahead and pop this up here. And basically, I want to show you, this is what we call a Japanese candlestick chart. And this allows us to see how are mortgage-backed securities performing. And a mortgage-backed security is the foundation of your mortgage rates. It's not the Fed raising rates, the Fed funds rate. It's not necessarily that the banks are greedy and want to charge you more and make more money. It's how loans are securitized and sold on Wall Street. We've talked about this before, but again, I want to keep it short and keep you guys focused. So looking at this, we see that mortgage-backed securities, they were very negative this morning. We saw a very negative reaction to this inflation data for this month. So what happened is this month we got inflation data. I don't have to tell you that inflation is bad. It went up to 9.1% year over year, meaning your cost of goods is 9.1% higher than they were a year ago. And that's 1.3% over the previous month. So this is actually June data that we get and reports in July. So the data over May, 1.3% higher. Now we look at what's also called a core CPI, or consumer price index. The core CPI, that takes out volatile food and energy components. So the idea, when the government looks at this data, they say, okay, well, food prices go up and down, energy prices go up and down, and we want to remove that volatility. We want to get kind of a more stable idea of what inflation looks like. That was still at 0.7% higher from the previous month, and about 5.9% higher from a year ago. So what happens, inflation, that makes whatever you could buy today worth less tomorrow. And let's kind of talk a little bit about that. Why is inflation so bad for mortgage rates? Well, what happens, let's say that I'm going to lend somebody $1, right? So I'm going to lend you $1 today, and you're going to give me 10 cents. You're going to give me 10 cents interest on this every month. So every month, while you've borrowed my $1, you're going to give me 10 cents back. Now, what can I buy for that 10 cents? Well, not much, right? But let's make this a little bit bigger. Let's, and I'm not bragging, but let's go through here. Let's say, okay, I'm going to borrow $100. So now we're going to go buy an amplitude 10, right? I'm going to borrow $100, and now you're going to give me $10 in interest, right? So I'm going to loan you $100. You're going to give me $10 a month in interest. Now, this month, what can I buy with $10? Well, how much gas would $10 buy? Let's say that gas is about $5 a gallon. I can get 2 gallons of gas. How much gas could I have gotten with my $10 a year ago? Probably 3 gallons, possibly even 4. So that's why inflation is bad on your return, because I'm still tying up my $100. Sorry, Ben. I'm still tying up my $100 that you've borrowed. You're still paying me that $10, but I can't get as much with my $10. So I'm tying up my money, and you're still giving me the same amount, but it's worth less because I can buy less with it. That's why in bonds, people are lending money and they're getting a rate of return. But yet, if inflation goes up, that rate of return is realistically less because they can buy less with it. So when we see inflation, that's why everyone is like, okay, rates need to go up. Because if the bank is going to lend you this money, you think, oh, well, the bank gets that money, but it's not really the bank. That stuff all goes on to Wall Street, right? But for practical purposes, let's say that you're going to borrow, hundreds of thousands of dollars. Well, if the mortgage rates was 3% versus 5%, that's going to be, how much could I get at a 3% mortgage when inflation has gone up versus now, if you want me to lend you that money, I need to get more back on that money because I can't buy as much with the interest. So now it's going to go up to a higher interest rate. That's why it costs you more to borrow that money. So that's why inflation is really bad for mortgage rates, and it drives rates higher. So when you see these inflationary readings, this is the kind of thing that, nobody wants to see with this data. So what happens is when we see this, we saw a negative reaction this morning, and see this fancy little chart here with this big dip. What happened was that report came out right about here at 8:30, and we saw, boom, this value dropped. The value on these bonds dropped, and that means mortgage rates got slightly worse. And they kind of stayed that way for a little while, but then look what happened. They clawed their way back, and they improved on the day to actually wash away all of those losses. So the initial reaction to this data was bad, but yet now markets are like, oh, okay, we're kind of okay with this. We know that this was coming. We know that the Fed is going to be fighting inflation. We're okay with this. And the same thing happened. The other number that we follow is a 10-year Treasury yield. And that yield went up over 3%. Now it's back down below 3% to 2.95. We rounded off 2.95. This is a very, very good indicator. So what I'm showing you guys right here, these are called technical indicators for where rates are going. So when I forecast and I say, okay, here's why it's a good reason, here's why I think things are going to get better. We have two reasons why that happens. We talk about the technicals, and then we talk about the fundamentals. So the fundamentals are what's happening in the big picture. The big picture is recession. A couple weeks ago, I said it's just like a race. Let's pretend we've got a horse race. One horse is in fear of inflation. The other horse is fear of recession. And these horses, fear of inflation took off early. And as fear of inflation takes off, well, that pushes rates higher. Then you've got fear of recession now starting to overtake fear of inflation. Fear of recession is going to push rates lower. So as fear of recession starts to increase and lead that race and push fear of recession back to the back burner, we're seeing mortgage rates improve. That's the bigger picture. And the idea is that we're very concerned that we're going to see, recession as an issue. One of the things that we use to track whether we're going to be in a recession, we look for what's called an inverted yield curve. So when I go back and I share the screen, and someone said use a tick chart, the ticks and basis points, for those of you that may not be familiar, they're just the number that's used to keep track of it. A tick is a 32nd, a basis point is 1/100th. But either way, you get that same kind of idea. So looking though at these charts, we look at the yield. Now, a 10-year Treasury yield, if I buy $100 worth of a 10-year Treasury, and again, this is an oversimplification, but I want it something that everybody can easily understand that I can explain quickly. If you buy $100 worth, you're going to get 2.95 back in interest. That's your yield. That's what you're going to receive, right? Well, if you're tying up a 10-year Treasury, it means you're tying up your money for 10 years to receive that $2.95. Well, what happens if it's a 2-year? Well, I'm only tying my money up for 2 years in this scenario. And let me make this bigger so you guys can see this with me as well, right? So I'm only tying up my money for 2 years here, but yet I'm getting a higher rate of return. Normally what would happen, the longer that you tie up your money, the better return that you're promised. So if you're buying a CD, you've got 6-month CDs, 1-month CDs, 1-year CD, 5-year CD. Normally, the longer that you tie up your money, that you put it in there and that you guarantee that you can't touch that money, you get a better rate of return. You're going to get more interest. You're going to get more money on your money. Well, right now, that's opposite. The way that the markets work, very, very strange things happen sometimes. Right now, you're getting $3 and let's round it, $3.12 for a 2-year, whereas a 10-year, which you would normally be getting a better return on, you're getting $2.96. So wait a minute, I only have to tie my money up for 2 years and I get more money back on that? Sign me up. Less risk, more return. This is a huge sign of an upcoming recession. Generally, when you look at this, what we call yield curve, it's inverted because a lower time period is bringing a better rate of return. when this happens, we usually see a recession. Recessions are good for mortgage rates. Recessions are bad for people. Okay. And I don't get me wrong. But they're good for mortgage rates because what happens in a recession, the economy needs to be stimulated. So lending costs come down to increase borrowing to get that money moving again. All right. So that's what we're looking at coming. And that's why I say, okay, so if you are buying a home and you've got new construction and you don't close on that home until a few months from now, you may see better interest rates in August or September than what you're going to see today because of that risk of recession and the market slowing down. Now, I want to show you guys one more thing. I'm going to show you what we call Fed futures. So this is the idea that, okay, well, the Fed is going to have a meeting, and at that meeting, they're going to raise or lower or maintain a Fed funds rate. And that's the rate that they use to manipulate the markets. To remember, it's not mortgage rates, but it's short-term lending rates. And it influences your car loans. It influences credit card costs. It influences your home equity loans, but not your fixed rate mortgages. So the next meeting is in 2 weeks, and it's going to be the 27th of July. Now, yesterday, there was a 90% probability of the Fed raising rates by 3/4 of a point. So right now, the Fed funds rate is at 1.5%. There was a 90% probability that Fed funds rate would go to 2.25%. Now, remember, when the Fed raises rates, it's not going to increase your mortgage rates. Mortgage rates are actually reacting early. Markets, investors, they are watching this probability and they're reacting early. So when the Fed raises rates on July 27th, which they definitely will, whether it's 0.5%, 0.75%, or as markets are starting to price in, maybe even an entire point, which I couldn't even go back and find the last time that the Fed, if they have ever increased rates by a point in one meeting. They have done it by 0.75 of a point. They just did it in June. Markets are saying we need more. We've got to slow this inflation down. The Fed needs to raise rates by a point. I don't know that the Fed has ever done that. I couldn't even find a history chart to show me that. So right now, markets are starting to price in this idea that the Fed may raise rates by 1%. And this will happen in July. If the Fed does raise rates, that actually helps mortgage rates a little bit because we're seeing mortgage rates react to the idea of what the Fed will do now. And that's why, when we have that bigger picture, we're not worried about the Fed raising rates because that's going to actually slow the economy, which ultimately is going to help bring inflation down, which is going to help stabilize and improve mortgage rates. As we go into the second half of 2022, where we're at now, we go into that end of the year and into 2023, we're expecting that we may see the economy slow down enough that rates have to actually improve, that the Fed may lower rates to stimulate the economy, and we would see mortgage rates actually improve. And that's why now is still a great time to buy a home. 30% of the mortgage transactions out there are refinance transactions. And you may need to refinance because you're looking to consolidate debt. Maybe you've taken on some credit card debt with, expenses being high. Maybe you're doing a home improvement loan. Maybe there's a lot of reasons that you may want to refinance now, even though rates are a little bit higher than they were before. One thing I would suggest is you want to minimize paying points or outlaying any extra fees to bring the rate down, because you will right now, if we pull out the crystal ball, we are expecting in 6 months or a year from now to see rates that will be significantly improved enough that you would want to see about refinancing. And every week we talk about the EARL. I don't have Nathan here as my wingman to tell you about it. So EARL stands for your interest rate rapid reduction loan. And that is one of the biggest benefits to a VA mortgage, is that you can do a refinance that is easier than so many other programs, and it can help to improve your interest rate. So if you buy something now, that's why there were, they talk about date the interest rate, but marry the house. And if you get yourself into a house now, you're going to be in that house for a while. But this mortgage with these interest rates, you have a very good chance of seeing an opportunity to refinance 6 months to a year from now. And if you do get a VA mortgage, you have to hold it for 210 days, pretty sure on that number, 210 days. And then you're eligible to refinance that loan. So you do have to factor that in, that you're not going to be able to refinance it a month later, but it's about 6 months, a little over 6 months. I think it might be 7 months, right? That's 7 months that you're able to then refinance that loan. So anyway, if you guys have any questions, please let me know. I am looking at the comments here. Everything looks good. And again, if you did watch this, please do me a favor, give us hashtag replay. Let me know that you were here. If you watched it live, put hashtag live. Let me know that you were here live. I do see quite a few people that have been watching today. And remember, we try to do these every Wednesday for you. In the summer, there's some things going on. Next week, I don't know if we'll be here to do it at this time. I'm actually going to be visiting live with the Vetted VA crew, and I will be in Texas to visit with Nathan and with Christopher. So if we're able to do this live, I look forward to doing it live with you. But you can definitely, look for this every week. If we have an exception, it'll be next week. But otherwise, we're clear every Wednesday, 12 p.m. Eastern time, whatever that is in your time zone, 11 p.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. And, definitely keep us here. So thank you, sir. Appreciate you, all of you guys, and have a fantastic day. If you have any questions, let us know. Take care, everybody. Bye-bye.